Hello, everyone. Good morning. First of all, thank you for your patience. My name is Soberss Nebhnani. I am the Client Relationship Manager with Jitendra Chartered Accountants. I warmly welcome you all for today's session. On behalf of our company, I would like to thank you for taking time to join us today for the webinar about insight on the UAE Corporate Tax. Before we start our webinar, I would like to give you a little brief introduction about our company. Jitendra Chartered Accountant, a division of Jitendra Consulting Group, is operating in UAE for last 21 years. Jitendra Chartered Accountants is a leading auditing, accounting, and consulting firm, providing various kinds of business services under one roof, having a team of 45 professionals from diverse, multilingual, and multicultural backgrounds who serve our client locally and globally. We at Jitendra Chartered Accountants provide services like audit, accounting, AML compliance, economic substance regulation, VAT, and corporate tax services. We are registered agent with FTA. Further, we provide other services like business setup in free zones, mainland, UAE, and foreign offshore, along with PRO and liquidation services. In addition to that, we also provide services for trademark registration, copyright, and patent filing in the UAE and around the world. Without further ado, let me introduce you to our keynote speaker for today's event, our company chairman and managing director, Mr. Jitendra Gianchandani. Mr. Jitendra Gianchandani has vast experience in auditing, accounts, and finance. As a member of Institute of Chartered Accountants of India, he has been exposed to the UAE corporate world since 1997. I would request Mr. Jitendra Gianchandani to please give us his overview on UAE corporate tax. Mr. Jitendra, over to you.
Hello, everyone. We all knew UAE is a happening place. In last few years, dynamics of the business have been changing in the UAE. In 2001, when I had started my practice single-handed, I had never imagined there will be so many compliances. First came in 2018, VAT, and then came ESR, UBO, and anti-money laundering law. And now corporate tax will be a reality soon. But we have also never in our wildest dream had imagined there will be great lockdown. More than 200 companies will be under lockdown. Flights will be grounded and we have to be isolated. But that happened. And we witnessed with confidence. And now it is over. So we are back in the business. Dear friends, I would like to welcome and thank you for being with us, more particularly our clients, banks, government, and prison officials. Talking about corporate tax, our JCI team will take you through the presentation, and I hope it will help you to prepare for the future. Talking about corporate tax, we all knew there is a 9% and threshold limit is 375,000 dirhams. Apart from that, while going through the corporate tax, we realized this is very much simplified version of international income tax laws around the world, such as India, UK, and European countries. And apart from that, there is no withhold tax. That means there will be not tax deducted at source. There are many more such aspects which my team will brief you very soon, and I'll be up to them to guide you and take you for the further journey. Thank you very much and wish you all the best. Over to Soberss.
Thank you, Mr. Jitendra, for your overview on corporate tax. Now, I want to introduce you to our speakers for this webinar. Mr. Rajiv Thakkar, Senior Tax Consultant, Mr. Chetan Mandani, Tax Consultant, Ms. Deepa Rai, Compliance and Tax Consultant. I request you to put your questions in Q&A box and please address to the panelists. And the same will be taken after panelists will finish the presentation. I will request Ms. Deepa to start with the insight on UAE Corporate Tax presentation. Ms. Deepa, over to you.
Thank you, Mr. Soberss. Good morning, everyone, and thank you for joining us today. This webinar will basically provide you with an insight about UAE corporate tax that we all know it will come into effect in the month of June 2023. So the entire discussion which we are going to have today is purely based upon the public consultation document that was issued by the Ministry of Finance in April 2022. Now, with these insights, the companies can look into their financial statements and they can make few structural changes if they want to. So when we talk about structural changes, like shareholding and accounting structural changes for better tax planning. But the point to note here is that any such final decisions about any structural changes should be done once the final decree law is issued. So let's start with the presentation. The very first topic that we are going to discuss is taxable persons. Okay, so the UAE corporate tax will be applicable on the type of persons included in the law. Let us understand what type of persons will be considered as taxable persons. So the first category is natural persons, which basically means individuals like us. Okay, so corporate tax is not applicable on our personal income. However, if there are any natural person or individuals who are running a business or any kind of commercial activity, for example, sole establishments, then in that case, corporate tax will be applicable on the business profits of the individual. So just to reiterate or just to echo the above point, corporate tax, which we are and will be discussing further in detail, it will not be applicable on the individual's personal income, like salaries, or if they have earned any income in terms of rental receipts, or if they've invested into a company stock and they are receiving dividends, then all such incomes are not applicable for corporate tax. Now, moving on to next taxable person, which is legal persons. Now, what is legal persons? Legal persons basically means entities or firm, organizations, corporates, and so on. So this corporate tax, it will be applicable on all the UAE companies, which basically means that any entity that is getting incorporated in the UAE, or even if the entity is not incorporated in UAE, but in some other jurisdiction, but its source of income is being generated from UAE, then such companies will be subject to corporate tax. So when we are saying that entity is not incorporated in UAE, it basically means that those are foreign entities, right? So the major point to note here is that even though the entity is not incorporated in UAE, but it has a permanent establishment, which means it is being managed and all the business decisions are being taken in UAE, then in such scenarios, corporate tax will be applicable on those entities. Okay, so few examples of legal persons are like limited liability companies, or we have public joint stock companies, or private shareholding companies, and so on. Now, the next topic that we'll discuss is about basis of taxation. Now, here we'll understand on what basis will we decide whether corporate tax is applicable or not on a particular taxable person. So the major element in order to check if a particular business is subject to corporate tax or not is its residency. So if a company is incorporated in UAE, then it will automatically be considered as a resident person. Okay. But a foreign entity in that case can also be referred as resident persons, provided the company is being managed and all the key decision about that company is being taken in the UAE territory. Now, in some cases, there might be a scenario that the source of income of a particular company is from outside the UAE. Okay, then in that scenario, if income tax was paid by that company in the foreign country, in foreign jurisdiction, then in order to avoid any sort of double taxation, the company can claim the tax credit against the corporate tax that it is expected or it is required or liable to pay in the UAE jurisdiction. So this was all about residents. Now, what about non-residents? Is corporate tax applicable on them? So the answer to that question is yes. Non-residents will also have to pay the corporate tax if their source of income is being generated from the UAE, or if the taxable income is coming from its permanent establishment, which we already discussed that if the entity has a fixed place in the UAE and where it is being wholly or partially carried on, all the key decisions are being taken in the UAE jurisdiction, then in such scenarios, corporate tax will be applicable on that particular non-resident entity as well. So moving further, we have exempt persons. So up until now, we looked upon the persons on whom the corporate tax will be applicable. Okay, so in this slide, we will just see, who all are exempted or basically relieved from the UAE corporate tax regime. So like, for example, there are any entity that are being wholly or majority of the shareholding of that entity is being owned by government. Then in such scenarios, corporate tax will not be applicable to that particular entity. Then there can be a business who are into basically production and extraction of any sort of natural resources like oil, gas, water. So in such scenarios, those companies is applicable for emirate level taxation as per the constitution. Okay. Then there can be a government department or government authorities as well. So those companies are also exempted from corporate tax regime. The other example could be any charities or non-profit organizations. Okay, so there will be few charities, few non-profit or public benefit organizations that will be listed as an approved entities in the cabinet decision. So only those entities will be eligible for exemption from the corporate tax regime. Now, there will be few investment funds as well, but in order to be subjected to corporate tax exemption, those investment funds need to meet certain few conditions. Okay, so moving further, we have exempt income. So we discussed about the taxable persons who are liable to pay tax. Then we discussed about the exempt persons who will be excluded from corporate tax. Well, there are few incomes as well that can be exempted from corporate tax regime. So let's say if your company has invested into some another company, okay, and it is receiving any sort of return in terms of dividend, then that particular dividend, that particular income will be exempted, okay, from the UAE corporate tax. Also, if a UAE company has a foreign branch or it has a foreign subsidiary, then the income that is being generated from such branch or such subsidiary will be exempted. So then we have income from in terms of dividends, income in terms of capital gains, right? So the dividends that we are receiving or a corporate shareholder will be receiving, or a capital gain that a corporate shareholder will receive, that particular income will also be exempted. If you are receiving a dividend from a UAE company or from a free zone person, then that particular dividend will be subject to 0% taxation. Now, you can also be receiving dividend from a foreign company, or you can earn a capital gain by selling the shares either in UAE or in foreign companies. So that particular gain or that particular dividend will also be exempted. But again, the point to note here is that this exemption will be applicable only and only if that particular foreign subsidiary is subject to corporate tax at least at 9%, which means it is paying the corporate tax at 9% or more in their foreign jurisdiction. Now, moving further, we have foreign branch profit. So if a UA company has a foreign branch, okay, then in that scenario, it has two options. Either it can claim foreign tax credit, or they can elect themselves to be exempted from the corporate tax, but provided the foreign branch is paying sufficient level of foreign tax in its jurisdiction country. So when we say sufficient level, it means either 9% or greater than that. Now, there are a few other exempt income. So let's say there is a non-resident company whose source of income is basically by operating an aircraft or by leasing a ships for international transportation. Then such companies will also be, the income that they are earning will also be exempted from corporate tax, but provided the condition here states that the same tax treatment is being given to a UAE business in that foreign jurisdiction. Only then the non-resident company in UAE will be exempted from corporate tax. So this was all about taxable persons, exempt persons, and exempt income. Now I will hand over the presentation to Mr. Rajiv to take you all to further slides.
Video allowed. Thank you, Ms. Deepa. Thank you for starting our journey for today or the webinar on insights on UAE corporate tax. Now, our first main topic is the free zone persons. I remember in 2017, when the Ministry of Finance has conducted their first seminar, physical seminar, over the applicability of a value-added tax, there they have kept a applicability of VAT on the free zone as a gray area. But in the public consultation document, we found our treasure that what is the applicability on the free zone persons. Let's discuss in detail. First, let's understand what is the free zone persons. The companies and branches that are registered in a free zone will be within the scope of the UAE corporate tax and will be known as free zone person. Simple to understand. The free zone persons at presently are enjoying tax incentives which are being offered to them by the respective free zone authority. That incentive, the UAE corporate tax through public consultation document has honored and confirmed that the tax incentives which the free zone persons at presently are enjoying will continue to enjoy that. But to enjoy such tax incentives, there are some conditions, there are some requirements, conditions to fulfill. There are requirements that which kind of businesses you can do. There are requirements that which businesses you should not do. So let us discuss all this in detail. First thing, what are the requirements? The free zone person are required to file the tax. Yes, the tax return filing is compulsory. Now, these all requirements are particularly applied to the free zone companies who wants to claim 0% corporate tax rate. Yes, public consultation document has given to the free zone person that yes, you can claim 0% corporate tax, but subject to some requirements. The requirements are tax filing is compulsory. The next is the free zone company has to do the audit. The audit requirement has been specifically categorically defined in the public consultation document that the yes, audit is mandatory. And the free zone company needs to maintain an adequate substance. Now, the definition of adequate substance has not been given in the public consultation document. But if we go back in 2020, wherein the economic substance regulations came into effect, there they have given what is the adequate substance. Let us understand what is adequate substance as per the economic substance regulations law, or let's say ESR. They say that the companies should have an adequate space like office or warehouse or any other thing, adequate employees to match with the revenue, and it has to be directed and managed. So particularly for now, for the purpose to understand adequate substance for the purpose of UAE Corporate Tax, we will take the definition as per the ESR law. And there are some other regulatory requirements also. Now, these regulatory requirements are the requirements that the free zone authority has imposed on the free zone company, or any other requirements which will be more clear when we have the final decree law over the UAE Corporate Tax. Now, as you remember, I have said that there are some businesses over which only the 0% corporate tax will be applicable. So there are some kind of businesses or transactions on if the free zone company is doing that, then only the free zone company can claim 0% corporate tax rate. Now, those kind of transactions are like, first, look at if you are doing business outside of the UAE, let's say exports. If the company is doing exports, the free zone person can claim 0% corporate tax rate. If the free zone company is dealing within same free zone, let's say Jebel Ali free zone company is dealing within Jebel Ali free zone, or they are dealing with any other free zone. Let's say a Jebel Ali company is dealing with the Dubai Airport Free Zone Company or Sharjah Airport International Free Zone Company. Those companies can claim 0% corporate tax rate. So they have said that and this is also as per the free zone regulations, that the free zone companies are mainly found for the purpose of doing exports or within free zone or the other free zones businesses. So the same concept has been taken at here at the UAE corporate tax level. And other income is income from certain regulated financial services directed at foreign markets. Now we have understood that to claim 0% corporate tax rate, what conditions the free zone company needs to maintain and what kind of businesses the free zone company can do. Now let us go with the different scenarios. As in UAE, we see that many companies and many groups follow different kind of legal structures. And that first is the free zone person having a branch in the mainland. Now, if a free zone person is having a branch in mainland, can claim 0% corporate tax on their free zone company and 9% on the mainland company if they maintain separate books of accounts. So they have clearly mentioned that if the free zone company wants to claim 0% corporate tax rate, then the separate books of accounts has to be maintained for the free zone company and the mainland company. Now let's take on a reverse side scenario, that if the free zone per company and the branch in mainland is not keeping separate books of accounts, then the free zone company as well as the mainland branch will end up paying 9% corporate tax on their whole income, including the free zone company income. So, simple requirement, keep the books of accounts separate, claim 0% corporate tax. Moving next, we have this also kind of scenarios in the various groups, that the one group company is in the free zone, one group company is in the mainland. So let's understand what are the corporate tax implication of that. Now, transitions between the free zone person or free zone company and the group companies located in mainland UAE are also covered under 0%. Yes, you can transit with your mainland UAE company. The free zone person can still claim 0% corporate tax rate, but the mainland group company will not be allowed to deduct such payments from the calculation of their taxable income. So the public consultation document is saying that if you are a free zone company and you are dealing with the mainland company, the free zone company can claim 0% corporate tax rate, but the mainland company will not be allowed to deduct the payments which they make to their free zone company. Now, let us take an example to understand it but clear. Now, in situation A, there is a mainland company who is purchasing from a mainland company, which is a third party, not a related party, not a group company. So their sales were 2 million, and as they purchased from a third party free zone company, so they 1 million cost of sales they can deduct, and the gross profit comes at 1 million. Now in situation B, purchased by a mainland company from their free zone related party. Their sales is 2 million, but as they have purchased from that free zone related party, they will not be allowed to take a deduction of 1 million. So their gross profit comes at 2 million. Now in situation A, as from the slide, we can see that the corporate tax is at 9% after deducting 375,000 exemption. The corporate tax liability comes to 56,250 dirhams. Whereas in situation B, the corporate tax liability comes to 146,250 dirhams. Now, this clearly shows us that the 1 million, which was not allowed as deduction, on that, the mainland company is paying straight away 9% tax amounting to 90,000 dirhams. Now, this is just one transaction. In the example, we have taken just one transaction, but we all know in the practical scenario, there are many transactions which any free zone company is dealing with their mainland UAE company or mainland UAE group companies. So from corporate tax, when it comes to effect, we have to keep a very close watch on this kind of scenarios. Otherwise, at the end, company will be paying a huge corporate tax. Now, we have understood what is the applicability of the corporate tax on the free zone persons with taking different scenarios. Let us just recap them and understand through this simple table. I request participants to take some time to read over this slide. So I hope our participants has read it. So let us continue. Let us take first example, AFZC. AFZC is a free zone company doing exports outside UAE or dealing in the same free zone or dealing in the other free zones. They can very well claim 0% corporate tax rate by meeting the simple conditions that maintain an adequate substance, get your books of accounts audited. Simple conditions. Now BFZC. Now the BFZC is having a mainland branch. If the BFZC keeps a separate books of accounts for the free zone company in the mainland branch, the corporate tax on the free zone company will be 0% and the corporate tax on the mainland is 9%. But if the BFZC does not keep the separate books of accounts for their free zone company and the mainland branch, then they will end up paying 9% corporate tax on the free zone company. And whereas the mainland company, 9%, it is still there. So BFZC having a mainland branch, simple conditions, maintain separate books of accounts. Now coming to our last example, CFZC. Now the CFZC is having a mainland group company. So the free zone company can continue to enjoy 0% corporate tax rate, but the mainland company will be subject to 9% corporate tax rate, but there is a disallowance of payments for purchase from free zone company. Going further, now from the previous slides, we have understood that the UAE corporate tax is clearly mentioning to the free zone companies that do the businesses within free zone, outside UAE, or with other free zones. But they have categorically defined in the public consultation document disqualification of 0%. Now, if a free zone company is having any other mainland source income, they will disqualify to be a free zone person and they cannot claim 0% corporate tax. So the free zone persons are encouraged to do the exports or the business within same free zone or the other free zone. But to this, there are two exceptions are there. So let us discuss that. Enjoyment as a designated zone person. Now, we all are in the VAT, in the UAE VAT since 5 years. So we know that what is the designated zone for the VAT purpose. Same concept has been taken to the UAE Corporate Tax. Designated zone means a free zone person who are covered with the boundaries wherein the entry and exit of the goods is strictly monitored. So a free zone person located in designated zone for VAT purposes can benefit from the 0% corporate tax rate even dealing with the mainland company in the case when the mainland company is clearing the goods from the customs. So a free zone company selling to a mainland company and the mainland company do the customs clearance. And if you remember under VAT, we all are very much aware about the RCM, reverse charge mechanism. If the mainland company is taking that things, yeah, then yes, the free zone person, the free zone company can still continue to enjoy 0% corporate tax rate. But let's take a reverse scenario that a designated free zone company is clearing the goods from customs. Then as we have done, as the company has done the transaction, which is not defined as per the law, which is not as per this exception. So the company will be end up paying 9% not on that transaction, the 9% corporate tax on all the transactions. Going forward, the public consultation document has said that there will be a withholding tax. Yes, there will be a withholding tax, but at 0%. A free zone person benefiting from the 0% corporate tax regime in respect of mainland source income, such income will be subject to 0% withholding tax. So yes, in the public consultation document, there is a mentioning of withholding tax, but at presently they kept it at 0%. There are some passive incomes the free zone person can have and still claim 0% corporate tax rate. Now, to benefit from the 0% corporate tax rate, if free zone persons can have a passive income like interest, royalties, dividends, and capital gains from owning shares in mainland UAE companies. So if the free zone company is having this kind of passive incomes, then the free zone company can still claim 0% corporate tax rate. Now, the public consultation document for UAE Corporate Tax has given one light that a free zone company can make one-time decision. It's an irrevocable election that once you have chosen that, you cannot not to switch it over back, can claim to subject to the regular corporate tax rate of 9%. But instead of 0%, a particular company can select to be charged for the corporate tax at 9%. Now, moving further, grouping. Let us again go back to value-added tax. In the VAT, if you want to make a tax group, simple condition, if one person is common in all the companies, they can make a tax group. But for the purpose of creating a tax group for the purpose of corporate tax, the consultation document, the public consultation document has kept a different requirement that a UAE resident group of company can elect to form a tax group and be treated as a single taxable person if the parent company holds at least 95% of the share capital and voting rights in its subsidiaries. Now at here, the public consultation document has come up that 95% shareholding criteria. In opposed to, in the VAT, there is simple criteria of the 1% common. And at the same time, the UAE Corporate Tax is limiting that the parent company or any of the subsidiary cannot be an exempt person, which Ms. Deepa has all explained to us. And a free zone person that is benefiting from 0% corporate tax rate. So this says that a free zone person cannot be part of any tax groups. Now, when you are making a tax group, so there are some conditions. That simple condition, all group members must use the same financial year, which at presently all the group companies in UAE or all over the world, we can say, are maintaining the same financial year for their ease of benefit to know the performance of the group at a particular day, at the particular date or at the particular year end. So this requirement, we are already satisfying it. And second part, a subsidiary can be part of the tax group, or if it is a UAE branch of the parent company or one of its subsidiaries. Now, we have created a tax group. So when we are in the tax group, so there might be possibilities that the one group company is transferring assets and liabilities to another group company. So there comes a question of what is the applicability of the corporate tax. So here is the answer, that intra-group transfer relief will be available for transfer of assets and liabilities between UAE resident companies that are at least 75% commonly owned with no gain, no loss for corporate tax purpose, subject to certain conditions. Now, what are these conditions will be more clarified, or will be clarified when we see the final decree law. Moving next, again in the group transfer of losses. Now, we have seen that in the group company, one company is making the profit and another company is making the losses. So yes, they have given a very good option at here that the group can transfer tax losses from one group company to another group company who is having the profits. Now, the main condition for that is that to avail group loss relief, the UAE group companies are at least 75% commonly owned. And as we understood from the previous slide, that there will be no transfer of losses with the other group companies who are like exempt companies or who are like free zone persons claim 0%. So they have given a very good option that yes, two group companies can transfer the losses against the profits of the other company, but one condition, that the ownership should be 75% common ownership. Moving next, the total tax loss set off will not exceed 75% of the taxable income of the company receiving the transfer losses in the relevant period. Now, at here, the UAE Corporate Tax is saying that, okay, if one company is having a loss and another company is having profits, you cannot set off 100% of losses by sin and pay no tax to the UAE. They are saying that 75% of the taxable income can only be offsetted. So, on balance 25%, the company is required to pay UAE corporate tax rate, UAE corporate tax of 9% after claiming exemption of 375,000. Now, coming back to VAT. Now, you all might be thinking that why at the corporate tax webinar, I'm again and again coming to the value-added tax. Because in the value-added tax, we are already in the 5 years. So when I am correlating with the value-added tax, the provisions of the value-added tax, it will be better for you to understand that, okay, the implication, what we are already understanding from the VAT perspective since 5 years are also there in the corporate tax rate for your simplicity only. Now in the VAT, they have given us one option that when a company is fully transferred or any particular department or particular section is transferred to another person, then it will be on a going concern basis, there will be no implication of VAT. Same has been taken to the UAE corporate tax rate. The corporate tax regime will allow certain corporate reorganization transactions, as for example, mergers, to be undertaken on a tax neutral basis, such that no taxable gain or loss arises. Moving to our next slide, related parties. Now, we all know what is related parties. We all understand that the related parties. What is the definition of related parties? Simple, that if there is a pre-existing relationship with a business, will be known as a related party. Let us keep the definition as simple as we understand. Now, but under the UAE Corporate Tax, they have come up with the transfer pricing rules. The UAE Corporate Tax will have transfer pricing rules to ensure that the price of a transaction is not influenced by the relationship between the parties involved. Now, let's take an example that if a company is selling to a third party, let's say they are selling at 100,000 dirhams. But if they are selling same goods or same services to the related party, the relationship will affect the transaction, and let's say it will be at 70,000 dirhams. But the UAE Corporate Tax says that the transactions with the related parties has to be at the arm's length. The corporate tax will apply the internationally recognized arm's length principles. Now, what are these arm's length principles? Or related party transactions and transactions with connected persons. Now, what is connected persons? That is coming to our next slide. Will need to comply with transfer pricing rules and arm's length principles as set out in the OECD. Now, OECD has set out some arm's length principle. So yes, for the UAE corporate tax rate, we have to go through the OECD. What are these arm's length principles? We have to comply with this. Now, for the transfer pricing, the UAE corporate tax has kept two requirements, basically a documentation requirements, that when we submit the corporate tax return, submission of disclosure for transactions with related parties and connected persons has to be mentioned. As we all know that under the IFRS IS 24, when we prepare the audited financial statements, we mention the transactions with related parties, connected persons, managerial persons. So the same disclosure we have to do in the corporate tax return. And at the same time, we need to maintain a master and local file where the arm's length value of the RP transactions or the related party transactions exceed a certain threshold in the relevant tax period. Moving next, connected persons. A new term. It is not defined in the VAT or any other existing laws in the UAE. Now, what are the connected persons or who are the connected persons? Let us understand first with the simple example that there is a company who is shareholders, 3 shareholders are there and 2 directors are there. Now, this 3 shareholders and 2 directors will be considered as a connected person. Now, we understood it simply. Now, let's understand through the definition what UAE Corporate Tax Public Consultation document is giving us. An individual who directly or indirectly has an ownership interest in or controls the taxable person is a connected person. Director or officer of the taxable person is a connected person. An individual related to the owner, director, or officer of the taxable person to the 4th degree of kinship. Keep in mind, 4th degree of kinship or affiliation, including by birth, marriage, or adoption, is considered as a connected person. Or any related party of this person will be taken as a connected person. Now, you all must be wondering that why we are discussing this definition of connected person. Now, let us take another example that there is a company which is owned by 3 persons, and during the year, they are taking some amount as a managerial remuneration. Now, after coming the corporate tax, that some amount can increase so that the company will pay less corporate tax. And on the other hand side, the individuals for the shareholders, 3 shareholders, on that there is no corporate tax. There is no UAE corporate tax, as Ms. Deepa explained to us. So by doing this kind of transactions, the UAE companies can lower their profits and pay less corporate tax. But our UAE government is smarter than us. They have put the stop. You cannot do this. Payments or benefits provided by a business to its connected persons will be deductible only if the business can demonstrate that the payment or benefit corresponds with the market value of the service provided. They are saying that, okay, an X amount you are giving to your shareholders or to your directors as a remuneration or as a salary or as any other thing, except profit distribution, then it has to be at the market value. Now, this gives a big question. What is the market value? And second, that is incurred wholly and exclusively for the taxpayers' business. So whatever payments you are giving to your directors should not be in personal nature. For this, there are small companies which are owned by one person. Therein, we might see that some personal expenses of the directors or the shareholders are charged to the company's profit and loss. But by this, now it is not allowed. That whatever payments you are giving to your shareholders is incurred wholly and exclusively for the taxpayers' business. Now, keeping what is the market value of the service provided as a gray area, because market value of the managerial remuneration, how to find it out at presently is a gray area. Let's wait for the final corporate tax law to be on a more clear side. We will understand that. And that is from my side. I will hand over to Mr. Chetan, Mandani to take over from here. Mr. Chetan.
So, thank you, Mr. Rajiv. Until now, we understood corporate tax applicability to the mainland companies as well as free zone companies. So we understood the positive aspect, or we can say welcome moves like 0% taxability for free zone persons, exempt incomes, exemption for foreign branch profit. But the Ministry of Finance has come up with few provisions to control the unfair advantage for the tax evasion, or we can say for better implementation. So let's understand what are these provisions. So first one is maximum deductible interest. So let's say your company has borrowed certain amount for business purpose and they are paying the interest on that loan. The interest paid on the business loan is deductible expense, but there is a maximum cap on the deduction of interest expense. So the interest expense paid up to the 30% of the earnings before deducting interest, tax, depreciation and amortization is only deductible. So we expect that the final corporate tax will provide more clarification on this provision. Second one is related party borrowings. So the related party is taking the above scenario that we have the loan, we have taken the borrowings from our related party. So in that case, the company needs to ensure that such transaction is at arm's length price. So as Mr. Rajiv explained, that the arm's length transaction means the related party transaction should be at par with the transaction with any other third party. The reason behind this is that the related party might have some kind of influence on this transaction or pricing. The second one is that interest charged by the related party is allowed for the deduction only if it is used specifically for the intra-group transaction. But there is no condition. There is one condition that company needs to prove that there is a valid reason for obtaining the loan. The third one is if you are paying the interest to the related party and that interest income of related party is charged at a corporate tax of 9% or any other tax in UAE or outside UAE, then it is considered as a valid reason to be valid commercial reason to claim the deduction. In case the lender is not paying any tax on this related party interest income, in that case, the full interest income will not be allowed to deduct. Moving to the next slide, we have offsetting and carry forwarding of losses. So Mr. Rajiv explained us about the intra-group or group losses, how we can set off that. So now here we have the loss which we can carry forward or how we can set off it. So we all are aware that the having loss in business is very common. If a company has loss in a first period or company has a profit in first period or loss in subsequent period, then in that case, the loss can be carry forwarded and set off against the profit of future profit. However, there are certain conditions which must be considered to claim these losses. The first one is losses can be set off only up to the 75% of the taxable income, and the remaining balance of loss can be carried forward. So let's take an example that you have a loss of 1 million in 2022 and next year you have a profit of 800,000. So 75% of the 800,000, that is 600,000. Only that amount can be set off and the remaining balance of 400,000 will be carry forwarded to the next year. Now the question comes, for how many years this loss can be carried forwarded? So the company can carry forward this loss for indefinite period, but there is one condition again, that provided the shareholding structure of the company of 50% should remain the same from the start of the period when the loss occurred till the loss set off. If there is a change in shareholding pattern of 50% or more, in that case the business line remains same. So now moving to the next slide, we have a non-deductible expense. So what is non-deductible expense? There are few expenses which are not allowed to be deducted while calculating the taxable income for corporate tax purpose. Such expenses are called non-deductible expense. There are two types of non-deductible expense. First one is partially disallowed, or second one is fully disallowed. So let's understand first one, partially disallowed expense. The first one is entertainment expense. So the any expenditure incurred by the company for any stakeholder like customer, supplier, employees, or shareholders, or any other stakeholder, the only 50% expense will be allowed for deduction and remaining 50% will be disallowed. The reason behind the disallowance is that such transactions are purely in the nature of personal expense and the business purpose is fully vanished in these transactions. For example, if you have a total expense of 10,000 for customer lunch or any entertainment expense, then 50% of that, that is 85,000, will be allowed for deduction and the balance amount will be disallowed. Then we have a fully disallowed expenses. Moving to the fully disallowed expense, we have a three kind of fully disallowed expenses. So the first one is any administrative penalty which has been levied by the authority, that will be fully disallowed and not allowed to deduct. Second one is a recoverable VAT, and the third one is any donation paid to any unapproved charitable organization, that will be fully disallowed. So now I will request my colleague Ms. Deepa to take you further for the next session of our webinar.
Thank you, Mr. Chetan. Now that Mr. Chetan has explained what expenses can be deducted partially or fully, and how can the losses be carried forwarded, up to what extent. Now, let's just understand the grounds, the basis on which a particular company can calculate its taxable income. So the first thing to note is that the income, the amount that a company will be using in order to calculate its taxable income for corporate tax purpose will basically be the accounting profit or book profit or loss amount as per the financial statement. Okay. Next, we all know very well that the accounting standards that is acceptable in UAE is International Financial Reporting Standards, and hence all the companies are required or they are expected to prepare their accounting and financial statements as per this particular standards. Now, if a company has a financial year, say for example, Jan to December or July to June, then that same period has to be considered as a tax period. You cannot consider your tax period different from what is a financial year end. So there can be few companies as well who are currently not following any financial period, but for them, in such cases, their default tax period would be considered as a Gregorian calendar, which is basically Jan to December. Now, the last point states that if there are any exchange or if there are any exchange profit or losses that was calculated at the end of the year, then such a gain or such losses cannot be considered by a company in order to arrive at taxable profit or loss amount. So these are the few grounds, bases of calculating a taxable income. Now that we have understood the basis, let's just see an example of how a company can calculate its taxable income or its corporate tax. So in this slide, you can see that. So before explaining the complete example, the deduction and everything, I would request you all to go through this slide for 10 seconds and then I'll proceed with the explanation. Okay, so in the given example, as you can see that we have considered two companies, company A and company B. Now, in order to arrive or in order to calculate the net profit income of a particular company, the first thing that we do is we deduct the direct cost amount from its sales amount. Okay, so as you can see on the screen, we have deducted the direct cost of 600,000 from the sales amount for both the companies, company A and company B. So the amount that we have received is 600,000 for company A and 400,000 for company B. So these amounts are basically the gross profit income of the companies. Now, from this gross profits, what we'll do is we will deduct all the indirect expenses. Now, what are those indirect expenses? So let's say you have paid salaries to your employees, then you have paid rent for the building, you have paid water and electricity bill as well. And then there are some entertainment expenses as well. So the total amount of all these indirect expenses will be deducted from your gross profit income. So as you can see on the screen, the total indirect cost of company A is 150,000 and for company B as well, it is 150,000. So we have deducted this amount from the gross profit income for both the companies. So the amount that we received is 450,000 for company A and 250,000 for company B. So this income will be considered as net profit income. Now, in continuation of this slide, now that we have received the net profit income, okay, now we'll compare this net profit income with the tax threshold amount, which is 375,000. So when you're comparing, if you see the screen, the tax threshold amount is 375,000 and the net profit income of company A is 450,000, which means it is more than the threshold amount. So this states that corporate tax will be applicable on company A at 9% rate. But when it comes to company B, the tax threshold amount 375,000 is less than its net profit income, which is 250,000. So the conclusion over here is that corporate tax will not be applicable on company B. Now that we have understood that corporate tax is applicable on company A, let's just see the corporate tax calculation for this particular company. Now we have income 450,000, the net profit income. Okay. Now from this particular income, we will be deducting any sort of entertainment expenses that has been incurred by the company. So in this example, directors' entertainment expenses was incurred. If we see on the previous slide, there was a director's entertainment expense of 30,000 dirhams. Now, as Chetan mentioned, that there are a few partially deductible expenses and fully disallowed expenses. Okay, so only 50% of the entertainment expenses can be deducted, right? Which means that the total 30,000 expenses, out of this total 30,000, only 15,000 will be allowed for deduction and the remaining 15,000 will have to be added back to the net profit income. So if we refer the continuation slide, we have added back 15,000 amount to the net profit income. So the amount that we receive is 465,000, which will basically considered as taxable income of company A. Now from this taxable income, what we'll do is we will deduct the tax threshold amount, that is 375,000. So once we do that, the amount we'll receive is 90,000 dirhams. And this amount is basically the chargeable taxable income, which means that on this particular income, corporate tax of 9% is applicable. So if we calculate 9% on 90,000 dirhams, the amount we'll get is 8,100 dirhams. So company A is required to pay 8,100 dirhams tax to its government. Now, the adjustment of entertainment expenses was not done for company B. Now, the reason behind that is Even if we would have added the 50% amount of entertainment expenses, that is 15,000, to its net profit income, which is 250,000. So the total amount we would have received is 265,000, which is still less than the tax threshold amount. Hence, CT calculation or corporate tax was not applicable on company P. I hope this particular example shows a clear picture of how a company's taxable income, how a company's corporate tax needs to be calculated. Now that we have understood what corporate tax is, how it needs to be calculated, and the other related topics as well, in this slide, we will just have a look on the proposed compliance requirements that ideally a company, all the companies should follow in order to comply with the corporate tax regime. Okay, so all the tax registered persons, each tax registered persons, they can file only one tax return as well as only one tax payment for each tax period. It's not that they can file two tax returns for one tax period. So the public consultation document clearly suggests that one tax return, one tax payment for each tax period. Now, the consultation document also states that it is not mandatory for the companies to submit any provisional corporate tax return or any sort of advance taxes. Now, we know that we need to file a tax return, we need to make the tax payment, but the main question here is, what is the deadline to do so, right? If you are supposed to meet certain requirements, certain obligations, then there are certain deadline as well within which you are supposed to fulfill that obligations. So when it comes to tax return and tax filing, the deadline is within 9 months from the day of when the tax period ends. Okay. Now, in few cases, there might be a scenario like a taxpayer feels that they are qualified for a tax refund, or they are eligible to get a particular tax income as a refund amount. So for such scenarios, for such taxpayers, they can apply to the FTA for the same, for refund purpose, but they need to demonstrate that they are entitled for such tax refunds. Now, there will be no transitional rules. Now, what does it mean? If there are any profits or any losses or any expenses that arises before the effect of corporate tax, then such income, such losses will not be considered in order to calculate the taxable income or loss of a particular company. Now, the corporate tax regime might allow some sort of relief in terms of financial and reporting duties for small firms and startups. Okay, and the reason to do so would be basically to keep their compliance burden to a minimum level. Now, moving on further, here in this slide, we'll just understand the tax filing and payment deadlines. So in the beginning of the presentation, we discussed that the corporate tax law will be applicable for the financial year starting on or after June 2023, and the tax payment deadline for the same would be 9 months. So let's say your financial year ends at June, in the month of June. Then your first corporate tax period would be July 2023 to 30th June 2024. And your first return filing deadline would be 31st March 2025. Now, if your company has the financial year end of 31st December, then your first corporate tax period would be 1st January 2024 to 31st December 2024. And your first return filing and payment deadline would be 30th September 2025. If your company is following a financial year of 31st March, then your corporate tax period would be April 2024 to March 2025. And the deadline for tax return, tax filing return, and tax payment would be December. So in a nutshell, if your first financial year would be first financial year after June 2023 will be basically your first corporate tax period. So the next 2 points is about registration and deregistration. So any firm that is subject to corporate tax, they are mandated or they are required to get themselves registered with FTA. And by doing so, they will receive a tax registration number. Now, in few cases, the businesses fails to register itself. Now, there could be numerous reasons. Either they are doing it voluntarily or unintentionally, but they fail to register themselves with FTA. So in those scenarios, what happens is the FTA itself will register such companies automatically for tax purpose. Now, deregistration. So if your company is liquidated or if it ceases to exist for any reasons, then in such case, the company is required to apply to FTA for deregistration. And the deadline for applying for making such application should be within the 3 months of liquidation or closure of your business. Now, we have understood in a nutshell, entire concept of corporate tax law. So with this, we come to the end of our presentation. But now I'll request Mr. Rajiv to provide you with few key takeaways from this presentation. Over to you, Mr. Rajiv.
Thank you, Ms. Deepa. Thank you for starting an Aniga journey. Now, as we know, what is the UAE Corporate Tax through the public consultation document and through our webinar, which I hope has provided you some kind of insights that what your company is required to do before we step into 1st June 2023, the date when we all will be in the UAE Corporate Tax regime. Now, first thing, that whatever changes at presently has came to your mind or to your thought should not be given effect until and unless we have the final corporate tax law. But as we have the time of almost 7 months, we must start the tax impact assessment of the corporate UAE tax on our companies. But what will be the UAE corporate tax on us? What are the changes we need to keep? What are the changes we need to make in our legal structure, in our shareholding structure, in our accounts department? That impact assessment we should start from today itself, because that will not be an easy exercise. For small companies, it might looks easy, or for big groups, it might look complicated. But as we have the good time, we should start now. What is the corporate tax impact on our companies? But the effect of the same has to be given only after we have the final corporate tax law. Now, other thing, that hire a qualified and professional accountants who can handle your corporate tax compliance. Now, as we can see from last 5 or 6 years, first we had excise, then value-added tax, then anti-money laundering, then economic substance regulations, then you went now corporate tax, UAE corporate tax. Now, year after year, the accountants, the accounts department responsibilities are increasing year by year. So the qualified or a professional accounts person will only help the companies or the corporates to keep them abide by the laws, various laws which we are facing at presently, and to save the companies from any kind of unnecessary burdens like administrative penalties and administrative fines. So hire a qualified or professional accountant who can handle this. The next thing is prepare the financial statements before corporate tax law comes into effect. Now, we all know that there are many companies who are maintaining their books of accounts. They are getting books of accounts audited also. But yes, even after the tax procedures law came into effect since 2019, which says that the maintenance of books of accounts is compulsory, there are still companies, there are still entrepreneurs who are still not keeping their books of accounts. So this is the time. Start preparing your books of accounts and prepare the financial statements before corporate tax law comes into effect. Now, by saying this, that when you look your financial statements, you look as your net worth. But in any kind of financial statements, there are some kind of assets or liabilities which are, or which maybe are not in good. Not in good means are not maybe recoverable or are not maybe payable. So those kind of incomes and expenses has to be taken out from our financial statements, and we should prepare the proper financial statement, the correct financial statement before the corporate tax law comes into effect. And the books should be complete. That is, no undisclosed income or expenses, and businesses must create capital in their books to support their investments and spending with proof. Let's take an example that there is a one shareholder company, and they have not created the books of accounts, and down the line, maybe after 2 years or 3 years, they went to buy, let's say, a apartment of 500,000 dirhams, or let's say 1 million pounds. So we do not know that what comes in the final corporate tax law, but maybe in future the authorities can ask you that, okay, show us the proof that from where you have purchased this capital, this apartment, by spending 500,000 or 1 million pounds. That time, the maintenance of books of accounts, the creation of capital will help us to show them that the authority, this is our books of accounts, this is my capital, which I have earned since years, and from that, we have done the investments. With this, we would like to end our presentation at here. I thank all the panelists, and more than that, to all my participants for their patience hearing. Before moving to question and answers, I would like to make here a small announcement that as soon as the final corporate tax law comes into effect, we will again send an invite to all of our customers, to all of our clients, for the webinar on the final corporate tax law, to again take you through the corporate tax regime. With this, I open the house for the questions and answers. Now, in that, we have a first question by Mr. Rayanu Jamat. Please advise whether this corporate tax applicable for free zone companies. I request Mr. Chetan to answer.
Hi, Mr. Ryan. Corporate tax will be applicable to free zone companies as well, as Mr. Rajiv explained earlier, that corporate tax will be applicable to free zone companies also, but the rate of tax will be 0%, subject to the conditions that all the transactions should be within free zone, within same free zone, or within another free zone, or export of goods. In that case, if you have any mainland transaction, in that case, you might not be enjoy the 0% tax benefit. You will have to pay 9% tax, but we are still awaiting the more clarification on that provision. I hope this answers your question.
Moving next, we have another question from Mr. Joshi George. As a company owner, is it possible to take monthly salary? To answer this, we have one slide for connected persons. Yes, as a company owner, you can take a monthly salary, but that monthly salary has to be as per the market rate. It has to be par with the rate available rates that is in the market. Now, what are this rate? At present, it's a gray area. Let's wait for the final decree law to understand it better. And we have another question from same Mr. Joshi George. Sorry. Should the salary considered as expenses? Then yes, if the connected persons, being you as an owner, the salary, if it is at par with the market, then yes, it will be considered as an expense and will be allowed as a deduction. We have a next question from Ms. Tanya Lazib. What is the minimum turnover before corporate tax is applicable? I request, at presently for the corporate tax purpose, there is no minimum turnover. The corporate tax is applicable based on the net profit, the profit which company earns after deduction of every kind of expenses from its turnover. If I go back to the example which Ms. Deepa has given, in that we have seen that from the sales we are deducting purchases like cost of sales. In that we are deducting administrative expenses. On the balance amount or the balance net profit, the corporate tax is liable to be paid. So for the corporate tax purpose, there is no minimum turnover. So I think, Ms. Tanya, this answers your question. Next, we have a question from Ms. Kundal. Is FZCO a corporate taxpayer? I request Mr. Chetan to answer this.
Yes, free zone company being a free zone person, that corporate tax will be applicable to them as well. As we explained earlier also, that the corporate tax will be applicable to them. But the rate of tax will be 0% subject to the condition as earlier mentioned.
Next, we have a question from Mr. Wasim. Audit were mandatory only for free zone? A very good question. This particular we have not incorporated in our corporate tax, but the public consultation document on the corporate tax is very much clear on this. It do says that if the law of the company, let's say if you are a mainland company, then the commercial companies law number 12 2015 is applicable, or if you are a free zone company, then the particular free zone authority regulations will be applicable to you. If that particular law is specifically is requiring the audit is compulsory, then yes, audit is compulsory on your company. At presently, we have seen, let's take an example that we have seen in the Emirat of Dubai, the mainland companies are taking the audit reports only on their choice, that if they require it for the banking purpose or for some investment purpose or for the management purpose. But the company's law is specifically defining that every mainland company is required to do the audit. So yes, now we can say that the audit report is compulsory for all the mainland companies, and the same kind of things are mentioned in almost all the free zone company regulations. So in general, we can say yes. I hope, Mr. Wasim, this answers your questions. Moving next. The next question is from Mr. Ismete. I have a free zone company. In order to maintain the company and fulfill all the required conditions and requirements, what is the annual budget? Now, I hope that this question you are asking for the adequate substance, and that definition we took it from the economic substance regulations, that is ESR. And we all know that in ESR, there are no specifically rules which says that what should be the annual budget, what should be the office size, or what should be the employees, how much should be the employees. So at presently, this is as per the company to decide that how many employees or what workspace or how many meetings in a year of the board of directors is required. So I think this suffices your question. We have a next question from Mantesh Kardakal. FZC is a holding company and a subsidiary in mainland. How corporate tax will be applied? I request Mr. Chetan to reply.
So if the free zone company is a holding company and subsidiary company in mainland both have a separate trade license, so the corporate tax will be applicable at 9% for the subsidiary company in mainland and 0% at free zone company. If they have a free zone company has any mainland group transaction with the mainland group company, in that case any payments made by the subsidiary company to the free zone company will not be allowed to be deducted. So I hope these questions your answer.
We have a next question again from Mr. Ismete Sultan Ali. If we are not able to maintain the company and fulfill all the requirements, and in case we want to finish and liquidate the company, what are the procedures? So, Mr. Ismete, at presently, what are the requirements or how the company can liquidate for the purpose of the UAE Corporate Tax is not defined. So we have to wait for the final law. We have a next question from Mr. Akhil Paul. The main source of income comes from the rental of the residential units that are purchased under the Jafza offshore company, and there are no other business done under this offshore company. Will the company come under the purview of the corporate tax? So at presently, as per the public consultation document, yes, Jafza offshore companies are also incorporated in UAE, so they will be considered as a resident for the corporate tax purpose. And as the residential units are there in the UAE, so the Jafza offshore companies having a UAE sourced income. So at presently, as per the public consultation document, yes, your Jafza offshore company is coming under the purview of the corporate tax. But in this area, we expect some clarity, some kind of clarity in the final law. So let's wait for it. I hope this answers your questions, Mr. Akil. We have another question from Mr. Janzus. I have a free zone establishment, sole owner company, and I receive salary as employee working for another company. Will this salary be considered as a free zone company income? At presently, I will say no, because you are having a sole establishment. So there you are running the business on a trade license basis, on a commercial basis. But when you are receiving a salary from another company, which they have clearly said that, which the public consultation document has clearly said that this is out of the scope of the UAE corporate tax. So yes, the salary which you are receiving from the other company will not come under the UAE corporate tax, but yes, your free FZE free zone company where you are a sole owner is under the UAE corporate tax rate. But let's assume that you will meet the conditions and you will continue to enjoy 0%. Thank you, Mr. Zamzus. We have a next question from respected Mama Victoria Lano. Though it's a gray area, but for CIT purposes, is it the assumption that the payments to connected parties is paid at market value or taxpayers needs to prove? So at presently, as per the public consultation document, they have mentioned that the payments or the services or the transactions with the related parties or the connected persons has to be at the market value. Now, your next question is who needs to prove? I believe that the taxpayers only needs to prove, and that is also as per the OECD rules. So I think this answers your questions. We have a next question from Mr. Arjun Balu. I have a free zone company and a mainland company. where I'm 10% partner. Free zone company has sold around 1 million goods to the mainland company. What will be tax implication on the mainland and free zone company? Now, as you remember, Mr. Arjun, we have taken this example in our presentation also, that when a free zone company is selling 1 million dirham goods to the mainland company, the free zone company can still continue to enjoy 0% corporate tax rate. But when it comes to the corporate tax calculation for the mainland company, this dirham 1 million will not be considered as a deductible expense. And on this, the mainland company will end up paying 9% corporate tax rate. So I think, Mr. Arjun, this answers your question. Next question is from Mr. Anil, BF Jersey. How much should carry forward? Does it include the 50% disallowance as well? I suppose that this question is for the loss carry forward. And when we are carry forwarding the loss should be calculated as per the provisions of the UAE Corporate Tax. So your question is that is it include the 50% disallowance as well? So yes, whatever tax loss that the company is carry forwarding has to be calculated as per the UAE Corporate Tax regime. We have a next question from Mr. Vishal Dhimani. Can you shed some light on tax rate for a company registered in UAE, which is part of an MNC group, registered abroad, and that MNC group has revenue more than 83 billion? Will that be 15% or 9%? Mr. Vishal, your question is basically related to the minimum alternate tax, which OECD has come up. So the group turnover of more than 83 billion is covered in that. So yes, that will be at 15% as per the guidelines given by the OECD. But let's wait for the final law. I think the UAE Corporate Tax will also honor the same and will have a specific rules or some light on that. So let's wait for the final corporate tax law. But yes, whatever the OECD is saying, that will be there by the UAE Corporate Tax also. So I think, Mr. Vishal, this answers your question. We have a next question from Mr. Parth. Hi, Rajiv. I have rent income from 2 residential and 5 commercial properties, but I don't have a trade license. Will I have to apply for the trade license? I request Ms. Deepa to answer on this.
So even if you have a residential property or a commercial property, unless and until you are running a business for commercial purpose, only then you need to apply for a trade license purpose. Okay. So also when it comes to income, if you're getting any rental income from the commercial property or from residential property, then that particular income will not be subject to corporate tax. So I hope this answers your question, Mr. Parth.
So due to time constraint, we will take 2 more questions, and the balance, whatever unanswered questions in the live webinar will be replied to all the participants personally. We have a next question from Mr. Manas. can bonus issued to employees and the directors, can this be included in the net profit for CT? So yes, for the calculation of the corporate tax, the primary is the accounting net profit, and in that the bonus given to the employees can be very well be deductible. And the bonus to the directors can also be deductible, but the bonus to directors goes through the connected persons provisions. So we have to see that the same is as per the market value or not. So for the employees, it's a straight away deductible for the calculation of the taxable income for the corporate tax purpose. But for the directors, we have to see that it has to be as per the market rate, as per the market rate. So Mr. Manas, I hope this answers. We'll take this last question from Mr. Vishal Bhimani. Also, there is any clarity on what will be the rates and method of depreciation straight line or WDV for taxation purpose? How will the opening stock be treated in the first return? So, Mr. Vishal, at presently the UAE draft that public consultation document is not clear on both the points, but yes, they are saying that the profit has to be prepared as per the IFRS, and IFRS accepts both this depreciation methods, straight line and WDV. So I expect that the final law will also validate that the depreciation can be calculated based on straight line and WDV. And your next question is how will the opening stock be treated in the first return? Now, the opening stock will be treated, will not have any impact on your corporate tax liability, as I think you have taken it from the VAT perspective, wherein on 1st January 2018, many companies is having these stocks in their warehouse, and those all were without VAT. So there was no impact of the VAT on the opening stock. So at presently, for the corporate tax purpose, let us consider that only, that there is no impact of the corporate tax on the opening stock. But yes, as we all know that for calculating cost of goods sold, we do make a calculation that the opening stock plus purchases minus closing stock. So through that, we will have our cost of goods sold. So I think this answers the question of Mr. Vishal. And with this, I once again thanks all my panelists and all the participants for their attendance. With this, I'll take an end to this webinar. Thank you so much. Thank you so much all for joining us.